G. Ability to define, incorporate and report on financial and/or non-financial key performance indicators. The curriculum identifies the ability to define, incorporate, and report on financial and non-financial key performance indicators, KPIs, as an essential competency because organizations rely on measurable performance metrics to evaluate operational effectiveness, strategic progress, and financial health. KPIs are quantifiable measures that help management monitor whether organizational objectives are being achieved. FP&A professionals play a central role in selecting relevant metrics, integrating operational and financial information, and communicating insights to decision-makers. Effective KPI frameworks improve accountability, strengthen strategic alignment, and support evidence-based decision-making across departments. Organizations increasingly combine financial and non-financial indicators to gain a more comprehensive understanding of business performance and future risks or opportunities. Financial KPIs measure economic performance and financial stability by evaluating profitability, liquidity, efficiency, leverage, cash flow, and growth. Common financial KPIs include revenue growth, gross margin, operating income, return on investment, operating cash flow, debt-to-equity ratio, and working capital metrics. FP&A professionals use these indicators to monitor operational efficiency, evaluate strategic initiatives, and support budgeting and forecasting activities. Effective financial KPIs should align directly with organizational objectives and provide meaningful insight into business performance. Strong KPI design also requires clearly defined calculations, ownership responsibilities, target ranges, and reporting frequencies to ensure consistency and accountability across the organization. Non-financial KPIs are increasingly important because they measure operational drivers and qualitative factors influencing long-term business performance beyond traditional accounting results. Examples include customer satisfaction, employee engagement, employee productivity, operational cycle times, customer retention, product quality, sustainability performance, and innovation metrics. Unlike financial metrics, which often reflect historical outcomes, non-financial KPIs are frequently forward-looking and help organizations identify emerging risks or opportunities earlier. FP&A professionals integrate these indicators into forecasting and strategic analysis because operational trends often influence future revenue growth, profitability, and organizational resilience. Combining financial and non-financial KPIs provides management with a more complete understanding of business performance and strategic execution. Defining effective KPIs requires careful alignment between organizational strategy, operational objectives, and measurable performance outcomes. FP&A professionals work closely with management and operational teams to identify metrics reflecting the most important business drivers and strategic priorities. Strong KPI frameworks balance leading indicators, which predict future performance, with lagging indicators, which measure historical outcomes. KPIs should also be specific, measurable, achievable, relevant, and time-based to improve usefulness and accountability. Organizations increasingly emphasize integrated planning approaches connecting operational, financial, and strategic data into unified reporting frameworks. Effective KPI selection therefore improves decision-making quality, resource allocation, forecasting accuracy, and organizational responsiveness within dynamic business environments. Incorporating KPIs into reporting and performance management processes requires reliable data integration, governance, and communication practices. FP&A professionals gather KPI information from enterprise resource planning systems, operational databases, customer relationship management platforms, and external market sources to create centralized reporting environments. Dashboards, scorecards, management reports, and business intelligence tools are commonly used to present KPI trends and performance insights visually. Effective reporting emphasizes clarity, consistency, and relevance because management requires timely and actionable information to support decision-making. Data quality and standardized reporting practices are also critical because inaccurate or inconsistent KPI reporting can reduce trust and weaken organizational alignment. Modern organizations increasingly use real-time analytics and cloud-based platforms to improve KPI visibility and responsiveness. Technology and analytics continue transforming KPI management by improving automation, predictive analysis, and integrated business planning capabilities. Modern FP&A systems allow organizations to monitor KPIs dynamically across departments, products, geographic regions, and strategic initiatives using real-time dashboards and advanced analytics. Predictive analytics and scenario modeling further strengthen KPI frameworks by identifying relationships between operational drivers and financial outcomes. Organizations increasingly recognize that KPI reporting should not focus solely on historical measurement, but also support proactive decision-making and continuous improvement. Strong KPI capabilities therefore strengthen strategic planning, operational performance, and organizational agility. Mastery of KPI definition, integration, and reporting enables FP&A professionals to support management expectations, improve strategic alignment, and contribute directly to sustainable enterprise value creation.